Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Chris Cahill. After some commentary by me, we will progress, and by that I mean move to a higher plane, when we speak with Sara Hanks. Sara Hanks co-founded CrowdCheck, which provides due diligence, disclosure, and compliance services for online capital formation. In other words, helps us all make fewer errors when we are trying to benefit from being able to invest in private securities through online sources, which is going to be a preeminent way of doing that if it isn't already. Ms. Hanks is also co-chair of the Securities and Exchange Commission's Advisory Committee on Small and Emerging Companies. We will speak with her a little bit about that. But first, some pressing issues. Bread, your child's lifestyle, drought, the machine that goes ping, and the Detroit Lions. Is bread really bad for you? Well, to gain some perspective on that, I direct you to the financialpoise.com homepage, an article there entitled, Is Bread Really Bad? Secondly, as you lavish funds on precious, i.e. your children, are you starving your retirement? In which way are the funds better used? What are the opportunity costs involved? If you're an economist and you like to speak that way, what are the opportunity costs involved in funding your child's lifestyle, in paying for a private college out of your funds rather than having precious go to a less expensive college and maybe take out a loan? What are the opportunity costs as regards your own ability to save for retirement and live the way you wish then? Okay, so that's bread and that's your child's lifestyle. Let's move on to drought. An Associated Press article of the middle of March by Darlene Superville is entitled, Obama Seeks More Coordination on Dealing with Drought, referring to drought, of course, in the United States. First sentence is, President Barack Obama on Monday directed the federal government to come up with a less reactionary and more long-term strategy for dealing with drought. That was a quote. I note the term reactionary. I don't know if it caught your ear, it caught mine. According to Merriam-Webster, the word dates from about 1840 and is defined as relating to, marked by, or favoring reaction, especially ultra-conservative in politics. So Ms. Superville used the term in accordance with the first part of the definition. That is, he was talking about something, a policy, relating to, marked by, or favoring reaction. I think she would have used the word reactive and not caused the confusion she's causing. Well, what's the confusion? The confusion is that some readers, probably older readers like me, are familiar with the term only as a description of a certain political persuasion. I don't know, maybe that usage is slackening. Maybe only reactionaries would even comment on it. Well, moving on. According to an aide to the president, about 12.5% of the continental U.S. was experiencing drought as of the time the article went to press. Now, the president issued a presidential memorandum and a separate action plan that set forth a series of goals for the federal government, which include sharing more information about drought risks with state, regional, tribal, and local authorities, and improving coordination of federal drought-related activities. I guess I'm not blown away by the by the scope of that action plan, it seems rather tepid, and the perspective for that is supplied to me by a recent book I've been reading, a 2015 book entitled Let There Be Water by Seth Siegel. I mention that also because Mr. Siegel will be a guest on this show in a few weeks. Mr. Siegel talks about the dramatic growth of water capacity in Israel. There's not more water there, there's just a better ability to gain it, use it, save it, and manage it over the 68 years of Israel's existence. Before 1948, the British, who had been administering the territory at that time, estimated that less than 2 million people could possibly live there, given the water shortage. It's largely desert or desertified. Well, 8 million Israelis live there now, and Israel also supplies water to the Palestinian Authority and some water to Jordan. In other words, Israel has solved its water problems and anticipates solving them as the population grows, perhaps to double the current amount over the next 20 years. But yes, compared to the story told in Let There Be Water, the administration's reaction to drought in the U.S. is rather tepid. Maybe it's the appropriate reaction, but the book is riveting. One man, his name was Simcha Blas, led the development of the National Water Carrier, a huge pipe underground that carried water from where it was, or is, in the northern part of Israel, to where it wasn't, and presently is now in the southern part of Israel, making the Negev desert bloom. Really remarkable is that the same man, Mr. Blas, also invented drip irrigation. This is where the pipes are laid right on top of the soil and shoot water right to where the plant is or is about to be. A lot more efficient than other forms of irrigation, any other forms. It's ubiquitous in Israel, not so much in the US and not so much elsewhere in the world, including not so much in other areas with tremendous water shortage problems. So looking forward to telling that story. All right, we've gone from bread, child's lifestyle, and drought. Let's move on to the machine that goes ping. If you're old enough to use the word reactionary only to describe ultra-conservative politics, you're old enough then to remember the Monty Python movie, The Meaning of Life. First scene in the movie is the miracle of birth, and it shows a dramatic scene inside a delivery room in which completely unsympathetic doctors bellow orders to the nurses, "More apparatus, please, nurse." Another doctor says, "Yes, the EEG, the BP monitor, and the AVV, please." Another doctor, "And get the machine that goes ping." First doctor, "And get the most expensive machines in case the administrator comes." Later on in the scene, the administrator arrives, the doctors switch everything on, machines jump into action, and noise and sound and flashes, beeps and thuds. The administrator comes in all his glory and says, "Wonderful what we can do nowadays. Ah, I see you have the machine that goes ping. This is my favorite. You see, we lease this back to the company we sold it to. That way it comes under the monthly current budget and not the capital account." Everyone applauds. Thank you, we try to do our best. Well, do carry on. Okay, why do I bring that up? I bring that up because that might have flown in 1983. It won't fly in 2019. Why? Because the Financial Accounting Services Board is changing the rules. What the administrator, who was played by Michael Palin, who I think, I'm willing to be corrected on this, is an accountant by training, who of course gave up his life for comedy and photography and other pursuits, is that operating leases of the kind described by the administrator, which allow a hospital to use a machine without owning it, are a device for improving the hospital's balance sheet. Let me explain. If a hospital buys a machine that goes ping and pays for it over time, well, those payments are going to weigh on the balance sheets. Those are liabilities. If instead The hospital buys the machine that goes ping, then sells it to somebody else who no longer owns it, and receives the ability to use the machine, however, by leasing it back and paying lease payments. So it's essentially buying the machine in the first instance through paying lease payments to the company to which it sells the machine, if you follow me. Well, then its possession and use of the machine and the costs associated with that do not appear on the balance sheet. They appear rather on the monthly budget, but not on the balance sheet, so that an outsider investing in the company does not see those costs if the outsider looks only at the balance sheet, the relative amounts of assets and liabilities. So a company might look healthier than it otherwise would if it relies more and not less on operating leases, which is why the administrator got all that applause from the assembled in the hospital room. Well, leaving aside the wisdom of that rule, it's no longer going to be the rule. Financial Accounting Services Board is finalizing new lease accounting standards in the coming months. Why? It's intended to increase transparency and comparability among organizations that lease assets. Transparency is intended to provide a clearer picture of company economics to investors, lenders, the Securities and Exchange Commission, and the international business community. All of this I am reading from a helpful descriptive article by the law firm Mintz, Levin, Cohn, Ferris, Globsky, and Papeo PC, specifically by Mr. Adam Watts of that law firm. And the name of the article is FASB Lease Accounting Changes, and you can get it by going to the Mintz Levin website. So to review, under current accounting standards, a lease is classified as a capital lease or operating lease, and under current practice, mostly operating leases. An operating lease gives the lessee a right to use the owner's asset without the requirement of including the lease on its balance sheet. Well, under the FASB standards to take place, public companies in the fiscal years beginning after 2018 will have to change the way they classify those payments. They will bear upon the balance sheet. For private company, the same will be true after 2019. So companies at that point that rely on operating leases will look worse. The optics will be worse. I don't know whether everybody will adjust to that, but future generations of moviegoers with accounting chops wonder what's going on when the administrator comes in and gets applause for announcing that the machine that goes ping was a leaseback. Okay, now we've done the machine that goes ping. Let's get on to the Detroit Lions and finish this off and get to Ms. Hanks. Your humble host saved an article from October 28th, 2015 on CBSSports.com at a point when the Lions were particularly miserable, and they've been miserable for years. This article is entitled, Lions Fan Starts Campaign to Buy Team Raises $520 and Counting by Jared Dubin. What's this all about? It's about GoFundMe. Speaking of online portals, although not really an investment portal, more of a crowdfunding benefits portal, not an investment portal. Anyway, William Clay Ford Sr. purchased Detroit Lions from Edwin Anderson and Lyle Fife in 1963 for $4.5 million. Well, frustrated with his team's lousy fortunes, Lions fan Jeff Tarnowski started a GoFundMe campaign to raise the $1.4 billion that it appears is necessary to buy the team. In the first 19 hours, Tarnowski collected $520. Well, I can update that now, which is March 22nd, 2016. Several months later, Mr. Tarnowski is up to $2,880. And if you want to contribute, go to GoFundMe, and the name of the campaign is Let's Buy the Lions. Well, sitting here as a fan of the NFL, the $1.4 billion seems a little steep after the retirement of Calvin Johnson, a magnificent wide receiver for the Detroit Lions, also known as Megatron. He has retired. Maybe the 1.4 billion ought to be more like 1.2 billion. And I wish Mr. Tarnowski all the luck he can muster in his effort to buy the team. That's enough of me. Let's get to Ms. Hanks. We have here with us today Sara Hanks. Ms. Hanks is a corporate and securities attorney with 3 decades of experience both in the United Kingdom and in the United States. She co-founded CrowdCheck, which provides due diligence, disclosure, and compliance services for online capital formation. She also recently was named co-chair of the Securities and Exchange Commission's Advisory Committee on Small and Emerging Companies. Her comments today are Sara's own and do not represent the positions of the SEC. I'd also like to mention that Sara has appeared as a panelist on a number of webinars offered by Financial Poise webinars. Financial Poise webinars, like this show, are creatures of financial poise. And you can go to www.financialpoisewebinars.com for more information. But recently, Sara was a panelist on crowdfunding from the investor's perspective, which is part of the Crowdfunding 2016 series of webinars. And I worked with Sara as moderator and she as panelist on the Crowdfunding 2015 series of webinars. You can also find some of these past webinars on Vimeo. Sara, thank you for being here.
I'm very happy to be here. Thank you very much.
Wonderful. Well, now, Sara, before all this, you were a Securities and Exchange Commission attorney. And lately, as I mentioned, I've been named co-chair of something called the Advisory Committee on Small and Emerging Companies. So I looked it up. A meeting has been held recently on February 25th, 2016. There's a webcast of the meeting. You can go and listen to the entire meeting. It's over 4 hours long. So I did not listen to the entire meeting, Sara. And my question for the benefit of our listeners and myself is, what happened at this meeting that investors would be interested in?
Well, actually, this was the first meeting of the newly reconstituted Advisory Committee on Small and Emerging Companies. And so it did a fair amount of scene setting and setting the stage for what the committee is going to do over the course of the next 2 years, which is our term. I should point out that there are 3 SEC committees that have input into the SEC's policies. There's this one, which really focuses on small companies who are both reporting with the SEC or who are still private and raising capital under the SEC's various exemptions from reporting. Then there is the Investor Committee, which takes a look at the protection of investors from the point of view of the SEC's mandate. And then more recently, the SEC created the Market Structure Committee, which deals with some very esoteric things like high-frequency trading. But I think all 3 of the committees have very important mandates, which is to help explain to the SEC what's really happening out there and what the impact of the regulations are on the real world. And so I'm very, very honored to co-chair of this committee. What we did in the last committee meeting is that we summarized where we were. And in fact, despite the fact it's 4 hours long, some of your listeners might find it somewhat interesting, because one of the things we did early in the session was just summarize all of the various exemptions that can be used by small companies who are raising funds. And of course, all of these are potential investment opportunities for investors.
Can I break in for a moment there for 2 reasons? Mm-hmm. We're talking about exemptions from the requirement otherwise to do a full-on SEC registration like a big company would. That's number one that I wanted to say. Number 2, if you want to learn more about that, you could listen to the 4 hours, or you could sign on to Financial Poise webinars. and
yes,
from our lovely panelists.
Yes, you could.
But that said, I apologize for interrupting. Please go on.
No, all of that's a really excellent point, because in many of the webinars that we've done together, we have discussed all of these various exemptions. The really exciting thing from the point of view of small and emerging companies right now is that we are about to have all of the suite of changes that were instituted by the Jobs Act in effect soon. So we are at least 2.5 years ago. Changes went into effect to Regulation D. That's the one where you can sell to accredited investors only. And those changes permitted companies to advertise their offerings, use, quote, general solicitation, and, of course, use the Internet to attract more investors. And then we have Regulation A, also known as Regulation A+. These were changes to the existing Regulation A that was never really used very often by any companies to make it more attractive. Those went into effect in June of last year. And then in May of this year, we have the final piece, Regulation CF, Regulation Crowdfunding, so-called Title III of the Jobs Act. That goes into effect just 8 weeks from when we're talking now, and that will be the full gamut of all of the changes that were instituted by the Jobs Act. So it's a very exciting time to be looking at the options that small and emerging markets have. So those are some of the things that we summarized. When we come to look at some of the issues that the committee is currently looking at or will be looking at over the course of the next 2 years, the one that matters to me most at the moment is data. And the committee had some presentations from various people who collect data, because you can't make good policy unless you know what's out there. There's absolutely no point trying to make decisions if you don't know how many companies are taking advantage of those decisions. So we had presentations from the SEC's own Department of Economic and Risk Analysis, DERA, and also from the Milken Institute and from the University of New Hampshire. And one of the striking things about the presentations is that we still don't have the answer to this question, which is, when we look at the data which is collected by the University of New Hampshire on angel investing, very, very early stage investing, and when we look at the data that is collected by the Department of Economic and Risk Analysis, DERA, who are looking at all of the filings that are made by people doing Regulation D offerings and filing Form Ds, when you look at what the Milken Institute is looking at, we still have no really good idea how much overlap there is. How many of the angel filings are really making Form D filings with the SEC? And this is something that is going to be a constant theme, I think, of the committee as we go forward.
At the very least, you must be identifying problems or issues or potential research topics that might not have been visible without the work of the committee. And I'm wondering whether, when you were an SEC attorney yourself, you noted a dearth of actual useful real-world data for the SEC to use when it's forming regulations and so on.
I think that's a really good point. Of course, when I was an SEC attorney, and I was a very proud SEC attorney, it was a fantastic place to work. We're talking about more than 25 years ago. So there was no information about anything. And the way we used to obtain information and trying to do rulemaking, we would frequently just call our friends at law firms around the world and say, how is this done in your jurisdiction? Or do you see this being a problem? In those days, there were very few data sources. We were behind the rules that became Rule 144A, which is the trading among qualified institutional buyers of privately placed securities. And private placement letter, I think it was called, was one of our great sources, but there were very few other sources.
At any rate, not systematic sources, where they're gathering data with the intent for it to be used in an analytical way.
That's right. I think it's much easier these days, but one of the things that is a constant theme in many of the groups of attorneys I end up talking to is the challenge of finding actual facts as opposed to just anecdotes or selected or filtered data.
This leads to a public policy question, because the SEC knows a great deal and it does a great deal. We know that, and they have a large presence, I think, even in the popular mind, as being an important actor in the public markets, and to the extent people are thinking about the private securities market, that as well. But here's the question. There are some who say that some of the great frauds up to, through, and beyond Bernie Madoff have actually been helped along in part by investors relying overmuch on SEC protections, meaning, well, if the SEC is protecting us, I don't have to be as vigilant. Do you think that may be so?
I wish it were in some ways. One of the things that strikes me about this is, do investors really actually know enough to rely on the SEC? I think another constant theme that keeps coming up among the SEC advisory committees is the sad state of financial illiteracy among the U.S. investing public, even if you're an investor. In many cases, you don't know as much as you think you know. Even very simple questions with respect to financial literacy are not able to be answered by many, many investors. So, what I would rephrase this whole question and say, I would like to think that people think the SEC is out there looking after them. I think that they haven't even considered the question in many cases. So I just don't know whether it's over-reliance, possibly over-reliance by those who know, congressional type, but possibly not the investors. I think one of the things in these great frauds is a very interesting aspect of psychology. It's not just the investors who need to change their mindsets, but also the regulators. When you look at what happened in the Bernie Madoff case, and there was a very clear, if anyone had listened to the whistleblower in that case, they would have seen that there was something very, very wrong. The problem is when you read, I forget the guy's name, but when you read his book, it sometimes reads like it's written in purple crayon. It's got this sort of tin hat conspiracy theory feel to it. And you can just imagine a situation in which, a young investigator, maybe in the enforcement division at the SEC, gets a phone call from somebody like that. And their initial reaction is, oh my God, the crazy people are calling. So I think what we really need when it comes to monitoring markets for fraud, we need people who are specialized in handling whistleblowers. And I've met a few people like this up on Capitol Hill. There's one or two senators' offices where there is a guy who knows just how crazy whistleblowers can sound at times, and yet is able to get over that. And is able to say, yeah, I know there's a lot of crazy stuff in there, but I see that there is a core of important information, and I'm able to help get to it. And I think that's what we really need to be able to give whistleblowers a fair hearing and make sure that regulatory agencies just don't go, oh, no, there's another crazy people. Because pretty much all regulatory agencies do get called by a lot of crazy folks every day.
Exactly. I mean, somebody who's paranoid might still be identifying real problems.
Exactly.
And somebody who's not paranoid might sound paranoid. You have to know, and you have to listen, and you have to have the ability to have mistakes not cost you your career, because these people taking these calls might be thinking, geez, what's the cost of me running this up the flagpole,
Mm-hmm. Yep, that's exactly right.
So stepping back from what the SEC does on a policy basis, or how it deals with people who are alerting it to things, let's talk about what your private enterprise, CrowdCheck, does to, in effect, help protect investors, perhaps indirectly, but could you just describe the enterprise basically?
Yeah, absolutely. So the SEC, in all of the areas where we work, and this is all non-registered exempt offerings, so Regulation A, where you go through the SEC, Regulation D, which is for accredited investors only, and Regulation CF, which is the new crowdfunding rules. And what we do in all of those areas is we help the issuer through the regulations to make sure they understand what they are supposed to do and present the information that they are required by the SEC to present. So we end up protecting the investor because the investor gets all the information that they need. We end up protecting the issuer because so that they are able to show that they have complied with all of the rules. And we also, of course, by doing that, protect the intermediaries who put the investors and the issuers together. We've got various different types of products. Sometimes we will be called in just to help with a filing to make sure that the disclosure is done properly. And sometimes we will be doing due diligence at the same time. So the SEC's rules don't require that services such as ours be used. They just set the rules that say, here, this disclosure must be made, this filing must be made. But in some cases, you really do need a third party to say, is this actually true? Are the words in this filing actually correct? And so what we're doing is, within the constraints that are set by the SEC sets the rules of the road, and then we make sure that everybody's driving on the right side of the road.
That's disclosure and compliance, but I know you do also the function of due diligence. Or maybe that was implied in what you were just saying. But just as a thought experiment, what would an individual investor have to do to check these things on his or her own?
I think you have to divide disclosure and due diligence into several different buckets. And one of the things that you have to do is the really, really non-sexy stuff, the corporate due diligence. If you're going to invest in a company, you need to know it's been properly incorporated. You need to know it's in good standing in the state in which it was incorporated. You need to know that it's legal for it to issue the securities that it's offering. You need to review all of the corporate documents to see if there's anything material or important going on, and look to make sure that there's no related party transactions. And that's one of the things that CrowdCheck does. I mean, we sometimes refer to this as the non-sexy due diligence, because there are other more sexy aspects, like, is this a good company? Is this a good business plan? But the corporate stuff is really, really important, because if you don't have all of your corporate ducks in a row, you could be investing in nothing. And we've had a couple of examples where investors, we're starting our process and the company says, oh, well, we've already had investors go through due diligence process, so this should be easy. And in one case, we had a very famous TV investor had invested in a company which didn't actually legally exist anymore. It had failed to pay its franchise taxes to Delaware for 3 years in a row and had been declared void by Delaware and had issued convertible notes in the meantime. So that one was a bit difficult to undo. Another case, we had a well-known law firm, Silicon Valley law firm, had a fund that invests and so had purportedly done due diligence on the company.
It's a law firm. Of course they did due diligence.
Yes, you would think so. But it turned out they didn't do the bit where you check to make sure that the board of directors had authorized the securities to be issued. So even the boring stuff you have to do. And then the industry due diligence, that's the thing that investors like to do more. Thinking about whether or not this is a good investment. We do not do very much of the specialized stuff. There are specialized sites on Propellex is one where there are platforms for specific types of offerings. In some cases, the intermediary will bring together experts so that you can rely on them. And in some cases, it's just a platform where intelligent people in that area hang out. But one of the things that I think is important in the whole due diligence sphere is never to underestimate your own life experience and your own knowledge. Normal people know how normal people act. So, for example, a few years ago, more than 10 years ago, I guess, Facebook, when Facebook was coming up, I would look at Facebook and I would go, oh, I'd never invest in such a stupid thing. Why would you do that? But all of the millions at that point, Facebook users would have said, yes, we use this. We use this, we find it useful. We don't just see it as some of my in-laws do, as a place to overshare and have feuds with the whole internet. We see this as a useful thing. We would invest because we understand the users. And you see that in a few offerings these days. There's a Regulation A offering that just went effective called Virtuix. Now, I know nothing about gaming and first-person shooters, but people who play those games look at this company which makes hardware for virtual reality games and go, yes, I get that. That is a fantastic thing. I want to own that thing, and I want to own that company. And so normal people's experience can be an absolutely essential part of the due diligence process. You don't have to be a specialist. You don't have to be a scientist.
Oh, I would think so. And I think that's a very powerful point, and people should always bear that in mind. You're thinking too, you're part of this. I wanted to mention, though, that you mentioned PropelX. PropelX, the person there who occupies your position at CrowdCheck, her name's Swati Chaturvedi. She's been a guest on this show and has submitted articles to AIMkts.com. So if you want to know about scientific, deep due diligence on the tech and science part, she's one person to look to. Second, I can't help commenting on whether Facebook is useful or not. I guess maybe what people didn't understand then, even if they thought it was useful, was that it's not just useful. I mean, the case could be made that Facebook now has a substantial part in composing our own personalities. All the 3 billion worldwide users of the web will ultimately feel its effects.
Exactly.
Quite an enterprise. Well, all right. So sticking with the more or less unsexy districts in which CrowdCheck does a lot of its work, are there ratings for the unsexy due diligence, corporate due diligence aspects of companies? Is there a seal of approval? Is there anything like that? Or will there, do you think, be anything like that if there isn't now on the horizon for people to look at and rely upon?
Yeah, it's a really interesting question, and I've seen a few people start up rating-type platforms or apps, and none of them have really taken off. And I think part of the reason is when we're talking about the online capital formation world, crowdfunding writ large, we're talking about a market where the rating, as in, is this a AAA or a AA or a AA minus, is way much less important than the emotional attraction that somebody has to a company or its product or services. Early stage investing, it's very, very difficult to compare apples to apples. You know, if I want to invest in an IBM bond or an Oracle bond, I can sit there and say, well, this is a better risk for the following reasons. With very early stage investment, that's really not the case so much. And I think that's one reason that we're not seeing any really apples to apples type rating systems developing yet. I would say that, of course, any company that has been through the CrowdCheck process, it's not like a rating, but it is a seal of legitimacy. So you've got that at least. And then the question is, well, I know it's legit. How much do I love the thing that they do? How much do I think it's going to be a success? One of the things that I would advise investors to be very careful of in this market is the fact that there is a lot of companies out there who produce research reports. And very, very frequently, these are paid for by the issuers as just another marketing material. So investors should be very careful about something that seems to have a third-party analysis of some kind, but really is just another way of touting the company's products. And I've seen that with several Regulation D companies, and I think we're probably going to see them with Reg A as well. Probably Regulation CF, Regulation Crowdfunding, probably too small for that kind of thing. Those companies are probably too poor to pay these research entities, but investors really should watch out for that because it can be very misleading.
Well, I suppose in addition to asking then cui bono, who's benefiting, they should be asking, and here my Latin fails me, who is writing?
Exactly. And
go ahead.
Yeah, and sometimes it's obvious and sometimes it's not. But when you get a recommendation of this is a good company, really find out who is writing it. See if there's some small print somewhere that says who is producing the document and who is paying for it. And if you can't work it out, be very suspicious of it.
Well, I'll tell you just as a brief aside that has nothing to do with Sara Hanks or CrowdCheck. I, as CEO of this company, get approached by people who want to provide webinars or provide written content. And I always do what you can do in a short period of time on the web, check into them. And some of them are quite dodgy, non-entities, literally non-corporate entities from other countries that can't be checked and don't really have an address and so on. So take the extra time, I guess, is the message. If you see something that sounds awesome, take the extra time to find out whether the awesomeness derives from independent research.
Absolutely.
All right, here's a nice little closing question. Although I know from experience, by the way, that Sara Hanks could go on and educate us for 4 hours if we had a... But you had surmises going into your CrowdCheck adventure. I mean, you've done all these interesting things, and then you decided to co-found CrowdCheck. So you had surmises going in with regard to your involvement in online investment platforms and how that would work out. Did those surmises yield surprises that you would want to comment about?
They did, rather. And one of them, of course, is one that I should have been aware of coming in. As your listeners may be aware, the Jobs Act was passed in 2012, and the crowdfunding regulations, the ones that are going into effect in May of this year, 2016, was supposed to be done by the end of 2012. And I thought they would be done sooner. So, and this is despite the fact I am an former SEC staffer, and I'm a person who's written rules, and they've always taken much longer than you possibly think they can.
Yeah.
So the timing has been kind of interesting. And one of the things I think that we've seen is the fact that if Regulation CF, Regulation Crowdfunding, had been passed earlier than Regulation A, the changes to Reg A that are known as Reg A+, we might have seen the market develop slightly differently. And I think part of the thing is that people said crowdfunding is a great thing. We don't have Regulation CF yet. Yeah, let's use Regulation A for it. And you saw the same thing happening at the state level, where a number of states, I think it's 23 to date, having waited in vain for SEC rules, just adopted their own so that you can do intrastate crowdfunding purely in one state. And those things I think would not have happened if the SEC's rules had come out earlier. So that's one timing thing, and I think what that says is just the markets will adapt. If there is a need for something, the markets will just shape the regulations the way the markets want. The big surprise is, though, I, with many people, thought that there were a large number of companies, good companies, who would be looking to use the new regulations. There's a lot of terrible companies out there, is the sad truth. There are a lot of terrible ideas. Uber for squirrels, Uber for trees.
Wait a minute, Uber for squirrels? Wait a minute, I've got some spare money. I think, anyway, go on.
So you've got terrible ideas, you've got terrible execution. One of the things that did surprise me is that the amount of competition among the online platforms for the good companies, because they want the good companies. The other thing that has surprised me somewhat is the slow take-up among investors. I'm older, I know lots of accredited investors, I frequently go to cocktail parties where I have to explain what I do, and people still don't know what any of this is. And then they think that why would you do such a thing as invest in early stage companies online? So those are the biggest surprises, is the number of truly terrible companies there are, in addition to all of the really good ones. And the very slow process by which investors have started to go, oh yeah, that's an interesting thing. And it's really, really happening slowly.
Well, I guess you could say, at least I'm formulating this theory, which isn't much of a theory, that when the Jobs Act was enacted 2.5 years ago, there was all this talk about crowdfunding, but as you pointed out, Regulation CF, which is crowdfunding for ordinary people, isn't in place yet. The regulations aren't there quite yet, but they will be imminently. But throughout that period, we've been hearing about crowdfunding, And I guess I'd like to distinguish between accredited investor crowdfunding, which is where there is, generally speaking, general solicitation of fairly well-off people and well-off people. We've been calling that crowdfunding, but it isn't the crowd, not the larger crowd. It's only about 10 million out of the United States. So I've been thinking that we should, going forward, always distinguish between the two as saying accredited investor crowdfunding and for real crowdfunding. I'm wondering what you think about that distinction.
There's actually a very similar distinction that I make. I mean, I refer to Regulation D, Regulation A, Regulation CF as accredited crowdfunding, SEC-reviewed crowdfunding, and true crowdfunding.
True crowdfunding. Sara Hanks, Chief Executive Officer of CrowdCheck, I thank you for your instructive comments.
Very happy to spend the time chatting with you, and I hope that these have been some interesting conversations for our listeners, and I would encourage them all to help early stage companies financing by investing in accredited crowdfunding, Reg A crowdfunding, or true crowdfunding.
Or real crowdfunding. Thanks a lot, Sara. It's been fun. To repeat, none of the comments Ms. Hanks made on this program represent any positions of the SEC. Further, nothing said by Ms. Hanks or me on this program constitutes legal advice or forms an attorney-client relationship with anyone, anywhere, anyhow. Accredited Investor Markets Radio is a weekly podcast and is produced by Stephanie Strait and can be found on www.accreditedinvestormarkets.com and on YouTube. Thank you for listening. Let's do this again sometime.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.